Hey, what's going on? Welcome to the one and only Stashing Worthy Acorns. I am your host, Russ. I put $50 into the Stash app, the Worthy Bonds app, and the Acorns app. I'm adding $20 a month. Every month for 2 years, I'm sharing the progress and results with you every week, so let's get to it. Big heartfelt thank you to begin with to all the new subscribers. I love that you're commenting and engaging, and I'm going to keep trying to put forth the very best content I can while I grow, and I'm trying to improve by at least 1% every episode. And if everybody in every aspect of your life tried to improve by just 1%, the world would be a much better place. Actually, first of all, you know what? No sleeves. It's over 100 degrees today with the heat index. We're going to be heading out to my brother-in-law's house after here to go swimming, so the sleeves fell off my shirt. What can I say? So I want to tell you about Jerome. Jerome was my next door neighbor, and I say was because Jerome passed away in April. Now, he was 82 years old, and it turns out he was a hoarder. And every time we had a garage sale, he would come by and just buy stuff. And I noticed a dumpster in his driveway one morning, and his Cadillac was gone. So I thought something might be up. Sure enough, dumpster filled up. That was taken away. And then a day later, another dumpster was there. So I took a walk by, had myself a little look-see, and it turns out that he was a hoarder. They were throwing away all this stuff. You name it, it was in the dumpster. So they've had now two separate estate sales. And I want to tell you what this taught me. This taught me that he was hoarding stuff that was worthless, stuff that largely had no value. And the point being is that I want to be a hoarder of dividend growth stocks, blue chip, premium quality dividend stocks. And if I hoard those, I know they're going to have value. And not only are they going to have value to me, but to my progeny, to my lineage, whoever I pass them down to. Not only am I passing down something of value, but I'm passing down something of value that will continue paying money to whoever I give that to. Very cool. Keep that in mind. There we go, Stash. I always started off with Stash, the S and the SWA. So I'm thinking the market could be turning here. We had a weird week. It ended on a down note. Don't know if a second wave's coming. We can't control that, but what we can control is what we invest in, and that we consistently keep putting money into the market, and we're not trying to time the market, but we're spending time in the market. And for me, I have a really long time horizon, and I'm doing that by buying some of the best companies like all I'm doing, if you're new here, is I'm putting $5 into either Johnson & Johnson, Procter & Gamble, or Apple. And the lowest of the three this week was indeed Johnson & Johnson. So no questions asked. I don't care what its valuations are at currently, what the PE ratio is at, what it's trading at. $5 in. It's one of the strongest stocks that I'm most confident in, and I have no qualms about putting money into Johnson & Johnson at any price, because as a dividend growth investor, I'm buying income. When I buy a share of a company like Johnson & Johnson, I'm buying a spigot that's coming out of the big machine of Johnson & Johnson, and that spigot drops money into my bank account every 90 days. The more shares I buy, the wider that spigot hole gets, the more money comes into my account. So Stash is at $168.14 for a nominal gain of $23.14 and a percentage gain of 15.96. As you're going to see in the bar chart, Acorns is a little bit ahead of Stash, but that's because I've really blown up with Apple. Apple got way up there, and it's taken a bit of a drop and a bit of a hit this week, but it's cool. I don't mind. I still love my dividend companies. We're going to keep putting money into them and collecting and reinvesting the dividends that these three fantastic companies pay me. Worthy Bonds. So I have two iterations of Worthy Bonds. If you're not familiar, they had Worthy Pure Capital 1, which was $50 million worth of bonds, and they sold out of that. And I got in on the very tail end of that. So they opened up Worthy Pure Capital 2, $50 more million worth of bonds out, and that's the one that I've been investing into. Now, full disclosure, I did some logo work for Worthy Bonds. You may be seeing some of my animations on their accounts I don't know what they're going to do with them, but as a gift, they gifted me 3 bonds, so that was $30. So that's the bump in Worthy Bonds this week. Worthy Bonds is just a fantastic company all around. I've had nothing but a good experience with them, from management all the way down to tech support. Fantastic job that Worthy Peer Capital is doing. So Worthy Peer Capital 2, I have $50.91, and Worthy Peer Capital 2 is $120.91 for a total value of $171.81. That has been a gain of $1.81. You may laugh at that and say that doesn't seem like a lot, but you know what? Worthy Bonds has never gone down below what I put in. It doesn't move with the market. They are bonds. They're not traded on the stock market, so when the market tanks, you don't have to worry about Worthy Bonds, hence security of bonds. Now, in exchange for that, you're not going to get the massive upswings and huge drops. You're just going to get a very slow escalator climb up and to the right, which is fine, which is something I love having as a portfolio diversification. And I was so impressed with Worthy Bonds that after one of my online high yield savings accounts dropped the interest rate, dropped the yield to below 1%, I took half of my emergency fund, which was $7,000, and put it into Worthy Bonds. And you can see that here I've added a few more, which is at $7,194.81 for an overall gain of $44.81. And check this out. I'm almost there. I'm almost at $1 a day, 0.9991 cents per day. They do pay you a flat fixed 5% interest. But the beautiful part is that is compounded daily, where my high yield savings account, CIT Bank, paid me once a month, and they pay me at the end of the month. So Worthy Bonds is paying you everyday interest, so your money is going to compound even that much faster. So since I am up $44, I did take $40 and I bought 4 more bonds. I added that money and I'm buying 4 bonds, which should be in there this week. And once that hits, I'm going to be up and over the $1 a day, which is my first goal. And then we're onward and upward to $2 a day. All right, Acorns. We're going to get through Acorns kind of quick because I have a stock that I'm excited to talk to you about. I want to get to it. So Acorns is at $170.29 for an overall dollar gain of 20.09 and a percentage gain of 13.40. One thing I want to talk to you about is if you click on the performance breakdown right here and you see in the large companies, I almost own a quarter of a share, so 0.24. And now that large company share is of an ETF, that's a Vanguard ETF, the VOO. So I'm not a big fan of Acorns because they are picking the ETFs that I'll be invested in based on your questionnaire at the beginning, if you wanted to be moderate or conservative or risky or and aggressive like I pick, so I want that upside. And then they're being charged by the fund manager, so in this case it's Vanguard. So it's 2 middlemen that you're paying to be invested in companies that, guess what? Check it out. Look at this. Look at this. The top 25 holdings in the VOO ETF. Boom, boom, boom. Apple, J&J, P&G. So I'm getting dividends from those companies. So you do get dividends with the ETFs. But personally, I would just much rather go right into the companies themselves and skip the middlemen. But if you do look at the ETF, they are weighting it very heavily in the tech sector. It's very tech top heavy. With Apple making up 5.46%. So it's just something I'm not a big fan of. They're picking what you're invested in. They're picking the weightings, and you have to pay them for the privilege of doing that, when I could just now, especially with Schwab has slices, Robinhood, Stash, you can buy fractional shares of these companies and just skip the middleman. But hey, if you don't want to, Acorns is perfectly fine for that. And good on you. So when we look at the bar chart, we do see that Worthy Bonds is now in the lead, but that's because we had that infusion, that quick injection of 3 bonds from the beautiful people at Worthy Peer Capital. And Acorns is a close second, and pulling up the rear now is my Stash, and that's because Apple took such a big hit this week, but it's okay. We're still up and to the right on everything. All right, so now I get to do the 2-minute take on a stock I like, and this week that stock is Eaton Corporation, ticker symbol ETN. So we may be going a touch over 2 minutes here, but that's okay because this is a fantastic company, one of my favorites, and I think you should know about them. And here's what I want you to know. So Eaton Corporation is a power management company that was founded in 1911. Their corporate office is in Dublin, which they did use a corporate inversion on after they acquired Cooper, and they pay a 12% corporate tax rate versus the US's 21%, which we know they did lower from 35% a few years ago. Their operational headquarters is in Beechwood, Ohio. What a beautiful building. They're very diverse, as you can see here. They're involved in aerospace, the data center, military, healthcare, residential, vehicles all over the place, which uses fluid power, electrical distribution, control equipment, auto components. And again, with the diversity, look at the products, all kinds of products, everything from power to ducting to filtration to plastics. Check this out. There even filtration is used in beer making. Currently, they're at $93.61. They have an earnings per share, the trailing 12 months, of $5.09. The market cap is $37.4 billion. They have a really strong balance sheet. The analyst price target is at $94.94. 18 of them gave that, so it is about fair value. The PE is 18.35, and you can see that the 5-year is at 14.84, so it is, according to the PE, about 24% overvalued. In January, they sold their hydraulic division to Danfoss for $3.3 billion, and they also sold Cooper Lighting for $4 billion in October. Getting on to the dividend now, my favorite part. They have raised the dividend for 10 years. They have never lowered or cut the dividend since 1923, almost coming up on 100 years there. And if you buy their yield, you are in the top quartile of sector peers for that starting yield. They just declared a 73-cent dividend, and if you get in by August 14th, 2020, that will be payable on August 28th, 2020. Now that is a 3.12% starting yield, which is solid, and the payout ratio is 36.93% of free cash flow. Here's a very cool infographic about how transformative that Eaton is, and check this out. I'm going to let the CEO, Craig Arnold, tell you about something that's really cool that he talked about in the annual investors conference on March 20th of 2020. Check it out.
Power will no longer only flow from left to right, from those who generate power to those who consume power. In this world, everything is a grid, with both the ability to deliver and to receive power. And in this world, the backup power for your home in the event of a power outage, it'll be your car. So in this world, I'd say it will require new solutions. And if you think about what Eaton is doing to participate in this, we're making things, we're making them intelligent, we're making sure that we connect them to the grid, we're making sure that they're cyber secure, and then from that, we're creating new business models around how we monetize the data that comes off our devices.
So they are expanding, they are growing. They acquired Power Distribution Inc., which powers data centers. That's all your tech stuff, so they want to be more into the tech side of things. PDI is a mission, you see it's mission critical data centers that it powers, power management solutions. They expanded into an e-mobility division in 2018 because they do want to be part of the EV revolution, which I want to be part of the EV revolution. And this is just one of the many ways that they are starting to branch out into the EV space.
Onboard battery chargers, where we're taking the AC power from the electrical infrastructure and charging the high voltage batteries in the vehicle to increase the range and replenish the charge of the battery as it's been used.
So that's why I love Eaton. It's one of my favorite companies to invest in. They are everywhere, all over the world, in more than 175 countries they've sold products to in my line of work with hydraulics and electricity. So there are a few risks that they don't have as much organic growth as they used to, which is going to potentially limit their top line through limiting mergers and acquisitions. Now, as I mentioned earlier, they did do a corporate inversion after they bought Cooper Industries to Ireland, so they don't have to pay the higher taxes that are in the United States. Hey, don't hate the player, hate the game, right? But because of that, if Ireland ever decides to raise the taxes and give a tax hike on corporations, that could be a little bit of a headwind for them. And then almost every company is going to be facing the uncertainty that we're heading into in the future, but we're all going through it. We're all going to see what happens. We're going to see if the global economy slows and if that'll impact Eaton. And then they're trying to expand into new markets, which could be risky. They're selling off things like the Cooper Lighting division and their hydraulics division, and they're trying to get into data and the EV revolution, the EV side of things. So I hope you like that. I hope you consider Eaton. This is just a very brief introduction to a stock I like, which is Eaton. Oh, I love Eaton. And if you love this show, please subscribe. Follow me on Twitter at RustyRam78. I do have a podcast I do called Dapper Dividends. I also have a website of the same name, dapperdividends.com, where my wife contributes to that. We just had an article, if you have kids, the top 5 travel toys for kids. And please remember, if you're going to invest into the stocks or stock market or bonds, to do your own research, do your own due diligence, speak with a financial advisor, a licensed financial advisor, of which I am not. I am here to just share some progress, share my thoughts, knowledge, and opinions for fun and entertainment. So take everything I say with a grain of salt and do your own research. Check out another video, and I'll catch you next week.